Thanks for tuning into Talking Point. I'm your host, Neeraj Shah. Our guest today is Mrinal Singh of InCred. Mrinal, great having you. Thanks so much for joining in. And it's an incredible move for the markets as well, Mrinal. How are you feeling at these levels and the conversations surrounding what companies are talking about?
So very interesting phase from a global context as well as a local economic context. See, we had overnight two inflation data. The CPI was at 4.8, which was a tad ahead of what Street was expecting. Even the US inflation data, the core inflation was 4.8, same number, but it was lower than what the Street was expecting. So the US markets are upbeat about it. The domestic economists are a bit worried about the core inflation. But yeah, but the markets is full of all segments across sectors. So we look at the market largely from a perspective of how individual businesses or sectors are doing. We also had two bellwethers on the IT reporting results yesterday. Subdued numbers, but that's reflective of the demand environment, not very surprising. Interesting place. Indian domestic economy is well poised to grow. There's no doubt about it. The next 5 to 10 years, the domestic economy growth rate is amongst the best that the world can see around. And it's a great place to invest. And accordingly, we obviously investors are looking to place ourselves into zones which will actually outsmart that growth. The global growth, particularly US and the developed world, will offer some kind of volatility. Let's see how things pan across, particularly in the North American geography, and let's see how the businesses from India are facing those demand environments play across. So, mixed kind of feeling on the businesses. The markets, in the meanwhile, are clearly upbeat, and I can understand why so. But then, from an investing perspective, we still focus on individual businesses, which is where we still see scope in select pockets to invest into.
Oh, great. And I would love to talk about that. A lot of actually, your first answer kind of encompasses what I want to understand from you in the interaction as well, Mrinal. So, first question, slightly macro, slightly broad brush. If the US inflation numbers don't show a nasty uptick, would you believe that flows into equities by virtue of the fact that rates may peak out, maybe correct at some point of time in 2024, and the domestic liquidity being what it is, that corrections, if any, will be short-lived because of the flow of money?
Well, at least that would be partially true for India.
India, yeah.
Clear growth trajectory is such that there is a lot of investable money which is sitting on the fence. So dips will be bought into, absolutely no doubt about it. What can change in a global landscape, as you said, if US inflation in particular remains benign, the investing community from at least that part of the world will get into what is typically called a risk-on mode, and it will show up into various emerging markets or riskier geographies, as they call as well. We have actually, for at least the recent past, for all the rate increases that we've seen, we've not had, in the markets at least, we've not had a paucity of liquidity. Something between the domestic or the foreign liquidity has persisted. It has helped price discovery in a very sharp and steep way. There are obviously segments within the market which have benefited. So I think we've not had paucity of liquidity wanting to get into the market. That's not.
No, but in fact, and hence my question. I mean, for the purist who's seen multiple, or actually not the purist, but for somebody who's seen a few of these cycles in the past, I've seen enough voices now starting to get a bit scary on private WhatsApp messages, right? But the flow of money is very strong. I mean, if we saw over 40,000 crores a piece in May and June, July has been no different either. In fact, surpassing both of those months, and the domestic liquidity stay as it is. So, therefore, I'm just trying to understand if money can keep on supporting the markets even at these heightened valuations.
Well, the reality is liquidity can only have a near-term influence on the prices. Finally, the prices will respond to the earnings and earnings growth, which is but we also need to be very cognizant of the fact that liquidity actually prepones the market responses. So the earning growth could be delayed. Excess liquidity actually prepone that, and which typically results in what we typically call, time-based correction in the market. So at least the financial year 23 was, in my view, a time correction. The markets went nowhere. If I remember right, by March 31st, 23, the one-year Nifty return was somewhere around 2%, which was kind of indicating that there is time correction that had happened because the markets had kind of accommodated a lot of earning growth already, so that time correction happened. But now we are entering a phase where a lot of capex or manufacturing related growth that is bound to happen will show up in the next 2 years. The markets at some point will kind of encompass those earnings. It is also interesting for all the noise about US recession. At least the data till now doesn't point in that direction. There could be a slowdown, but I don't see a recession related data. The corporates in US have obviously responded and acted preempting that. And I think in the next 6 months, it will be very clear if we are talking about a recession in US or if we're talking about a slowdown in US, and that to a segment of US, if at all.
Got it. Okay. So having spoken about liquidity now, I heard you say that you find comfort in select pockets, but there are also some newsmakers that I want to talk to about. You alluded to IT earnings. What is interesting, Mrinal, for me, and maybe mistakenly so, but the TCS CEO spoke about no large drawdowns. The HCL Tech CEO in a conversation with me spoke about drawdowns visible in particular segment in ERD, but still they have maintained a guidance for FY24, and therefore talking of some fairly significant growth CQGR for the next 3. We did an interview with KPIT day before yesterday, my colleague, and they are fairly confident, although the size is different, but I'm just saying it's an ER&D leader, fairly confident about growth in their segment. Is IT looking skittish, or is it kind of reaching levels or valuations or a mixture of both where you would be inclined to look at them afresh?
Well, very interesting question. And at least the arithmetic of the ask rate for growth, given the guidance that some of these companies have, points to a very strong trajectory ahead. But we should be aware that these numbers and these guidances can be changed. So let's not just, they're not cast in stone.
Sure.
But the reality is at least IT, somewhere in the next 3 to 6 months, most investors are aware that a quarter or two are weak. But I think somewhere in the next 3 to 6 months, it would be worthwhile to actually increase weight in IT. The stocks would have accommodated in terms of valuation the kind of slowdown that we see. In any case, the US manufacturing is also showing very robust growth. The US technology is actually showing some kind of slump, so it's reflecting into different segments of large IT businesses at least. And I would say if there are businesses in IT space which are heavier towards US manufacturing or telecom, I think they clearly would weather this slowdown far, far better than others. And that's how we would place ourselves as well.
Okay. Okay. So maybe 3 to 6 months down the line, but some of these businesses could be interesting to look at. Viewers, note that point. The other one, and I'm just sticking to this export-oriented firms. We're just doing a small analysis, Mrinal, still not out as yet, back here at BQ, about chemical companies and how much they've lived up to the guidance given, at least post-COVID, because 2020 was a bit of a write-off year. Almost all of the sample companies, and we took 9 or 10 of them, each quarter after quarter, if they've given a guidance, they've more or less lived up to it, save for a few exceptions. Now, the reason I'm saying this is because these companies obviously know what they're talking about. They're not quite missing their guidance numbers, most of them. And when one looks at the guidance given by some of these companies because of the upcoming projects for FY26 or 27 as well, these companies look very reasonable if they look very punchy right now at FY23-24. So my question is, because it's a specialized industry, is this the time wherein they're going through a state of flux, a time to look at them, or would you believe that time is some time away?
Well, one of the most important economic event that has happened in the last 3-6 months is China has fully opened up. And that has relieved the supply chain related constraints that the global economies were seeing, which is also helping control inflation a bit, which is also helping, meet the demand. which was getting constrained due to lack of supplies. So chemicals is a very large base in China. It is anticipated it is going to hit businesses which have benefited out of the Chinese capacity being shut. But I think that logic does not apply to specialty chemicals. Businesses in the chemical space which are into specialty side, I think, but for some hiccups, will continue their trajectory. A lot of them has expanded. And most of the Indian businesses are far more conscious and aware about environmental standards than a lot of their global peers who compete on price. So that itself puts them in a very formidable spot in terms of both ESG framework as well as cost and capabilities. So I would say I would not give a blanket statement on chemicals. It's a very large space, frankly, but the recent lull in those prices clearly creates opportunities, and a couple of them, I would say, particularly in the space of specialty chemicals, is how we see.
Got it. Now, what boggles the mind is the kind of fervor for defense names. A project announcement, an order announcement, and the stocks are up on a circuit, and they just continue to do that. But the book-to-bill ratios may be impressive, but what these stocks have done is remarkable. I mean, does this worry you, or do you believe that these price moves are warranted? Mrinal, can you hear me? Mrinal, can you hear me? Okay, I think we have an issue with the feed there, but I was really wanting to know about two things before we wrap up this interview. One was on defense. So that was a key thing. The other one that I was really looking forward to understand from Mrinal Singh was what's the kind of trajectory ahead for pockets that he said that he finds value in? Because when one scans the space currently, if you look at the PSE 500 or the NSE 500, for absolute value, it's probably available in pockets which are just not showing any kind of growth. A sniff of growth, a whiff of opportunity, and markets are pricing these stocks in left, right, center. I mean, just look at the price moves that have happened in some of the defense names, and that tells you a story. Well, unfortunately, may not be able to get that view because there seems to be some issue with the feed out at Mrinal Singh's end. So we'll call it a day on this leg of Talking Point. But thank you so much for taking the time out and being with us.